investment meeting. Today is 11/19/2014. It is 5 minutes of 11. We are at the New York City Comptroller's Office, 1 Center Street, 530, room 530, New York, New York. We need a roll call of trustees.
Ms. Caroline Walker.
Here.
Ms. Susanna Vickers.
Here.
Mr. Antonio Rodriguez.
Here.
Mr. Stephen Cassidy.
James Slevin and Steve Cassidy's proxy.
And Mr. James Levin.
Here.
Mr. Ed Brown.
Here.
Mr. John Kelly. Mr. James McGowan.
Here.
Mr. John Farina.
Here.
Mr. Paul Furrow.
Here.
And Mr. James Broward.
Here.
Commissioner Douglas White.
Here.
We'll have 24 votes and a quorum when we start the meeting.
Let's start the public agenda.
Okay, we're going to have a brief meeting today, and we'll start off with September results. September was a down month, down about 2.2% for the portfolio versus 1.9% for the benchmark. Then of course October went up, and so you've seen this up and down movement since the Federal Reserve stopped its expansionary money policy over the summer. They've been withdrawing quantitative easing, and over the next year or so we should see them raising interest rates. So we're no longer in a favorable environment for the markets. It's neither favorable nor disfavorable, and as such we've brought the overweights in U.S. equity in. You'll see as we go over it that the weight has come down a little bit, and if you took a snapshot today, it's come down even more, and I'll talk more about that. But we're now in a position where we rebalance the portfolio. When various asset classes go up, we trim them. When they go down, we add to them, and as long as the markets are chattering around, we actually make money on the movement. So the volatility is our friend in that type of environment. Where it starts to be wind in our face again is if the markets were to take off in a particular direction for a prolonged period of time. But generally speaking, when you're in uncertain waters as we are today, having a neutral policy towards asset classes is a good idea. There are a few tweaks to that I'll get into when we come back to rebalancing. I'm going to turn it over now to Martin to take you through some of the pieces of the outlook so you can see where the pressures are in the market today. Martin?
Yes, thank you, Scott. I just want to add one thing. While we are into the neutral level for U.S. equity, taking down that overweight that we've had for quite some time, the reality is the asset allocation compared to other public funds has a higher U.S. equity allocation than other public funds for fire and for the other New York City system. So if the U.S. equity market does very well, we'll still do very well compared to other public funds because of that overweight, and that's fallout of the basket rules and the unique rules that we operate under. If you turn to page 15, I want to show a couple of slides that will show the volatility that we've experienced through the summer and October. As Scott mentioned, July was a down month, and remember last month August was a good month. September, we're going to go through here, was a down month. So the quarter was slightly down. October, the first half, looked to be that was going to end up being bad. And then all of a sudden, the second half of October started looking good, and then into where we are today in mid-November, we're now back at record highs for the U.S. equity markets. So things have done very, very well. And on pages 15 and 16, we show some two charts on how the dollar is doing versus other currencies. And you'll see at the very right of both of those charts, you'll see that the dollar, at least on page 15, this is a dollar versus other large major currencies, such as the euro and the yen, has significantly increased to very close to a 5-year high, just off of it. And that's because the U.S. economy is strengthening, while the strength in the economy is slow on historical comparisons at this point in the cycle. So 2% growth would not be considered strong growth at this point in the cycle, but it is nevertheless growth when you compare it to Europe and Japan, where you either have stagnant growth or even outright recessions where you have negative growth. So prices in the U.S. for the dollar, the U.S. has been a haven, not just for folks like us, but for other investors, because the economy is growing. So would you rather invest in an economy that's growing or an economy that's not growing? So it has finally occurred to investors, and the volatility that we've seen in the markets has occurred also in the dollar, that the dollar has strengthened. And on page 16 you see versus the euro, where the euro has weakened. The decrease shows the weakening euro. It was in the 130s for years, and it had been a bit of a conundrum because academically we're all taught that if you have an economy that's strengthening versus an economy that's not strengthening, and if you have interest rates in that economy that's strengthening, that's either higher or expected to be higher, it would attract capital flows, which would make the dollar or that currency stronger. It hadn't happened. Well, it finally is happening, where the euro is weakening versus the dollar. That does ultimately hurt U.S. exports, so there are political implications to this. So, for instance, in Europe, they want a lower and cheaper euro because they're in recession or close to it, so they want to help their exporters in Germany and other areas. And the way to help that is to make their prices cheaper, and the way to make their prices cheaper is that their currency depreciates. So you have competitive valuations going on. And that's finally showing up and finally happening. The question was why it took so long. So it's happening on, you see it on page 15 and 16. Take a look at page 18. This is the volatility index, otherwise known as the VIX. And you'll see at the very end, and this is September and October, a big spike up. And you'll see for a couple of years, while quantitative easing was going on, the volatility kind of disappeared from the market. So the VIX was, you'll see the low of 10 earlier this year. That historically, not just in this 5-year period, but historically is an extraordinarily low number. And it was low because every investor knew that the Fed would be there as a put, as a backstop in case something went wrong. Well, once the tapering entered the discussion and the $85 billion bond buying, known as quantitative easing, was starting to go away and being tapered. And in fact, now it's down to zero. They still have a $4 trillion balance sheet of what they bought. And so the next question is, when do they start raising short-term interest rates? But that finally hit the market, that concept hit the market back in August and September and in the first half of October, and that caused the VIX index to more than double. Well, if you take a look where we are right now, the second half of October and November, the market seemed to have calmed down, just like the market was ignoring it for several years and then started paying attention to it in the fall and late summer. Now it's back down to 14, which historically is a fairly low level. So we went through a period of volatility in the markets where the markets were going down, and it was expressed also in the volatility index where people were buying puts as protection against their portfolios or as outright bets that the market would go down. But that seems to have quieted down. And we'll have a slide later that shows what the returns are. The 10-year Treasury on page 20 is a very interesting chart because you see a little dip. It almost doesn't show up. And the reason it doesn't show up is because it happened intraday. So the close of the day never happened. But there was a day, I would call that the capitulation day, that happened not too long ago within the last month, where 10-year Treasuries actually went down to about 185? 186. And what happened is when it went below 2%, remember before, just to give context, before the beginning of the year, when tapering, everyone was expecting, well, supply and demand. If the Fed isn't buying, supply and demand would say, Fed isn't buying, other people have to buy, therefore prices will go down and yields will go up. Well, on the way up, they've gone down, the yields. And the reason that's happened is because when investors were selling were selling equities around the world. Where was the money going? It was going in cash and was going in safe havens such as treasuries. When it's going in safe havens such as treasuries, the prices go up, yields go down, and there was a day where it actually went down intraday below 2%. Once it hit below 2%, it triggered all sorts of stop-loss trading, and some fast money was making an incredibly volatile day. I think the day started at 215, went down to 185. I think the day ended up at 215. So if you didn't know what happened, you see it unchanged, you say, well, nothing happened, but it was an incredibly volatile day. At the time we printed this, the chart shows that the 10-year Treasury was at 235. This morning it was about 233. So it's roughly where it is today. We expect rates to go higher. We just don't know when. Another chart that shows this is on page 21, which shows in red high yield spreads versus over treasuries. In other words, what you're getting paid over treasuries to take the high yield risk. And in blue showing investment grade spreads. You see a spike in red that happened also. Now we're at 415 basis points over treasuries, but the spread spiked to 500 or so, and maybe even a little higher intraday. We're now back down to where we were. So just like the other charts show, the market was concerned, was volatile, and that was calmed down and seems to have digested at least the tapering issue, as well as the geopolitical risks that are around the world that we live in, that the market was ignoring, that started paying attention to it over the summer. One of the last charts I'll show you is on page 25, which shows how the three large indexes performed over the last year. This is a one-year chart. So white is the U.S. Russell 3000. Yellow is the emerging markets, and orange is EFA. And you'll see that emerging markets and EFA are roughly flat, and U.S. is up. That has been the story and has been the story for several years, where EFA and emerging markets have not done as well. I will tell you that the EFA market, part of the story is the currency. So if the currency is declining, and as you saw from the previous chart, the euro is finally declining against the dollar, while stock prices may be stable or even going up, if the currency is going down more than stock prices are going up, you will end up with down stock prices, and this is unhedged. So that's what we're seeing, but that also presents an opportunity for at least our managers. So what were the returns for the month of September? Scott mentioned that the returns were not good. It was negative. If you turn on the next page, which does not have a page number on it, but it comes after page 26, so presumably it would be page 27. The first set of numbers in the middle shows Russell 3000. You'll see it was down 2%. Fiscal year to date, which is in the middle, was 0.01, so it was roughly flat for the quarter. The next set of numbers shows EFA and emerging markets. EFA was down almost 4%, and emerging markets was down almost 7.5%. Those are huge moves in the month of September. Lots of negative numbers here. Hedge funds were down just a fraction, up for the fiscal year. Core plus 5 was down 88 basis points. On the next page, high yield was down nearly 2%. Even bank loans were down 0.5%. TIPS were down 2.5%. And convertibles, because of the hybrid nature of the bonds and the equities, were down over 3%. Even REITs were down, because they're tied to interest rates, were down 5.8%. If you flip to the next set of pages, which is October, we'll go through October numbers next month, but this is a hint of what's to come. While that doesn't affect the quarter, you'll see this reversed. And as I told you, and you're probably reading the papers, that the equity markets are hitting new all-time record highs. Well, this shows you why. Because in October, the Russell 3000 was up another 275, so it undid the September downturn. EFA was down 145, not because, as I mentioned, that the stocks are doing badly, but because of the currency is depreciating against the dollar. Emerging markets were actually up 118. Hedge funds were up, at least the benchmark was up over 1.25%, core plus 5, because as you saw before the chart, the treasuries prices were going down, was up 117. Next page, high yield was up, Bank loans were up, tips were up, convertibles were up, and REITs were up over 10%. REITs are tied to interest rates, so that was would have really strongly affected in a positive way your returns in October. We'll show those numbers to the board next month. So the next page, which is actually labeled as page 31, this is the page with the bars. As Scott mentioned, all the way on the left, you'll see the 1 month return was minus 219. As you saw, if you remember just a few moments ago, it was barely a positive number on the page. September was a rough month. For the fiscal year to date, and we'll have the quarterly report next month, the return was minus 90 basis points. I will tell you, based on what we've seen in October and November to date, based on the numbers that I ran last night, this is completely estimated, that negative 90 basis points probably turned into a positive, roughly 90 basis points, what we are today, or thereabouts. We'll have those numbers for you on a more exact basis next month. So next page is page 32, which shows the pie chart and where we are with the overweights and underweights. I'm going to turn it back over to Scott.
So this is a look at where we are relative to our policy. As Martin mentioned, we have an aggressive policy at this portfolio, 68% in equities. That's, gas pedal all the way down. And the reason for that is we're shooting for a 7% return. And in this type of low interest environment, to get 7% in an overall portfolio is really stretching it. And working with the actuary and setting these goals and everything, you have to have an awful lot of equities into the portfolio. So this is going to be a volatile portfolio. It's just the structure of it. We even had extra offense in the portfolio, and you can see that on the left when the bars are above zero, and that is extra equity above and beyond the 68% policy. So we really had a lot of aggressiveness into the portfolio. And we don't think that it's wise to do that to the extent. It was all the way up at the top end of the band when I came on this summer. We got it here at the end of September, about halfway. If you take a snapshot today, it's not all the way down, but it's way down, and you have more of a balance between the overweight in U.S. equities in green versus large international markets or developed markets in yellow, and emerging markets in, brown. And so we'll stay pretty balanced across those areas. Europe and emerging markets, as Martin alluded to, are more troubled than the U.S. is right now economically. That's the bad news. The good news is their stock markets are a lot cheaper because the expectations aren't as high. So we've evened out our bets there. On the bond side of things, over on the right, things aren't neutral. The rates are so low that there's a big risk that when interest rates go up, our long-term bonds will get hit pretty hard. And so what we've done is we've torqued the portfolio just slightly towards short-term bonds. So the gray bar all the way on the right, which is cash or short-term bonds, anything less than 4 years, is overweight. And the blue bar, as well as the purple bar, which is long-term bonds and inflation-protected bonds, are underweight. And the reason is that's the most vulnerable part of the portfolio as interest rates go up. So as the Federal Reserve goes from not buying bonds or quantitative easing to raising short-term rates, and then that gets fed into long-term rates going up, that'll hit our long-term bonds. It'll hit the short-term ones too, but not as much. And so we're playing a little defense on the fixed income side. And that's really the only tactical weight that we have. Otherwise, we're playing the rebalancing game, which is our normal position. Unless there are really good reasons to, we play the rebalancing game because it's the best odds of success for asset allocation. With that, I'll turn it back. Martin, did you have anything else on September?
I just want to say on this page, the underweights will be covered when rates go up.
Yep.
And even if rates go nowhere, and don't go up, it doesn't help us get to 7%. So that's why the underweight is there.
Yeah, I mean, it's tough to hear when we've just got 17.5% in the rearview mirror, but if we do we borrowed from the future, I've said this before, but that 17.5, kind of borrowed from future years. So if we post another 7% year, that's an extraordinary achievement. We should just figure that that's a stretch goal going forward and have our minds set accordingly. And as you hear managers come in, you hear one talk today that, are they coming in to present?
Yes.
Yeah. These guys do fairly high-risk real estate loans, and their expected return's 12%. Well, 12% doesn't sound extraordinarily high. Well, it's extraordinarily high when you get zero for not taking any risk, and short-term bonds are only getting inflation back plus, a couple basis points for long-term bonds, 2.3, 2.4. So, the spread is the same as it always was, but the rates themselves are low, and therefore that 7% that we're shooting for, that's a big number for us to think about it. We just got to all reset our sights on that.
What type of real estate is that? That's high risk.
Yeah, he's going to come in and talk about it, but he's lending money against real estate, and what they'll do is they'll come in and lend in situations where the banks won't loan, where you've got a there was a talk yesterday about condominium development, didn't get finished, there was some trouble in it. They saw a way to work with the developer, and they came in and they were the lender. They can get good rates by spending a lot of time underwriting the loan and getting the odds in their favor. But they do take some risk. They don't take as much risk as if they own the building, but they do take some risk, and they get paid for it. And so they'll be careful not to invest our money unless they're really getting paid to take the risk. So you'll hear Spencer come in and talk about how he does that, how he's done it in the past. Very impressive guy. But in other board meetings, it's like, well, you're only getting 12% for that? Well, 12% is a monster return in this environment. Okay. With that, I think we're ready to go. Do you have anything else, Gordon?
Do I have any other comments? I just want to have the board turn to pages 37 and 38. These are the market value charts. So if you take a look at the market values on page 37, this is the 1 year. The market value was $10.596 billion, off of the all-time high set in August. The market value as of today is just shy of that. Just shy of the all-time high, but is obviously higher than it is today because the market's at an all-time high, the equity markets. The next page shows 10 years worth of results, and the note on the bottom is really what I point out that the 10-year return as of September was 7.5%. The rest of the package is starting on page 39. 39 is a summary of all the asset classes and returns, and starting on page 40 are all of the returns for every single manager and asset class, and then we also have private equity, real estate, cash flows, and funds. The one thing I want to point out is, because this was a negative month, our most defensive manager, which is Schenkman, as would be expected, they were underperforming during a bull market. As you'll see in the quarterly report, and as you have seen in prior quarterly reports, this is why we build complementary portfolios. They outperform. So, one second, let me just make sure of that. I believe it was true. Pardon me. I'm sorry. Schenkman's not here? Never mind. We have too many war meetings. I apologize. Never mind. But the key holds, which is that defensive managers did better in down markets. That's why we have defensive managers and aggressive. So I apologize for the manager that does not exist here. That's on me. I apologize. That's you put them in the watch list. That's all I have.
Okay. Thank you, Mr. Watchlist again. It does my heart good. That's the first mistake I've seen him make since I got here. It's good to see that he can make one. With that, we'll go into trustee education discussion. When I got here, I did the listening tour and had discussions with a lot of you and your peers and other boards. And this idea came up that we ought to be spending more of our time providing educational opportunities for board members, for a chance for us to sit down, maybe away from the regular meeting, and discuss topics that are on everybody's mind. I've brought this up with all the different boards, and there are a lot of different thoughts about what people would like to get some education on. There are people that are interested in fees. Some people intensely interested in fees and want to sit down and understand it. Some of the alternative asset classes, the fees are very complicated in terms of how they're structured. And people would really like to sit down and understand that and how do you reduce it into kind of plain English. Some people are raising issues like governance and diversity and other things that we'd look at. Wanting to get more depth of understanding in asset classes like infrastructure. We could have a session. So the idea would be that we'd have a meeting for all the trustees and all the boards. Maybe we bring in an outside expert to talk on it. Not a vendor. I think we would keep vendors out of the room, but an outside expert, maybe a college professor or something. Maybe even another pension fund to come in and tell us how they tackle a similar problem, if it's a problem that is being attacked different ways across the country or around the world. And so I'm open to suggestions. I just wanted to informally reach out to you guys and see what you thought. If there are issues that you'd really like us to discuss or want to make sure that they get on the agenda, this is the time to bring them up, or if you think of it after the meeting, shoot an email to Susanna, who's kind of collecting all these things. But I'll open the floor and see if there's interest in any topics.
Other boards, new trustees have, asked for orientation type sessions.
Yeah, I'd be open to that.
Yeah, we have a lot of new trustees.
Yeah, we've asked for that.
Okay.
Okay.
Yeah,
Yeah.
it's sort of the basics, kind of taking you through these are your fiduciary duties. This is how we look at these asset classes and
So
so on.
when you become a new officer in the fire department, if you've never worked in a high-rise area, they would take you to the high-rise.
Right.
Can you take us down to Wall Street so we can see
Right.
what it's like? Well, I mean, we would always take the
maybe.
city council to the fire academy.
Yeah,
So maybe
Yeah.
it would be.
we'll come up with something like this. Good idea.
Maybe the Bahamas.
They did it when I think when I first got became a trustee.
Yeah, so we'll. That's a good idea, but a sort of primer for new trustees, and I was.
When I first became a trustee, I think they did it in conjunction with Baruch College over at their vertical campus on 24th
Right.
Street
Right.
for all the new trustees. It was for all the trustees.
Yeah. Well, it's good, and there's some groups that do a really nice job of this. They sort of specialize in public pension plans, and they could come in and give us some thoughts. Yeah, be good. Carol?
So the controller's office has heard this from us before, but I figured I'd just share it so everyone, I know all the boards hears the same thing. All of what Scott said I think sounds great. He mentioned governance. That's something we've suggested at other boards. In particular at NYSERS, they did an RFP in 2013 to get a governance expert to come and sort of look at the fund, make suggestions and do some training. So if this board was interested, we've talked to NYSERS again, we could try to do something in conjunction with them to talk about governance. And then also an idea we have is risk management. We think it would be good for us to learn more about, how should we learn about risk? What should we know about risk? How, if at all, should BAM, be given more resources to consider risk more? So those are the two things we raised at the other boards.
Thanks. I should mention, I just thought of it when Carolyn was talking, sort of best practices and so forth. We in BAM, the controller announced this when he first got into office, but we're now getting around to putting the RFP out and everything. We're doing a very extensive best practices review of ourselves to look at, how does BAM operate, all different aspects of what we do. And one of those aspects is how do we work with the boards. So you all may end up in some conversations with the consultant that we bring in, kind of evaluating the job that we're doing. So we want to make sure we're at a best practices level as well. So that it's a little different than what we're talking about, but be ready for that, and we'll appreciate constructive criticisms and look forward to it. Anything else while we're on the topic today? Okay. If you think of anything, please don't hesitate. Shoot Susanna an email or me. Either one of us can take it, and we really want to make sure that we're responsive to what you're looking for. And like with the new trustees thing, we got new trustees in NYSERS, new trustees here, and even trustees who've been on for a while but wouldn't mind a refresher can show up to this kind of session. Yeah.
Have you got an idea of when? Possibly after the holidays?
Yeah, definitely after the holidays. Yeah, I would expect us to do a couple of these this year, a couple of them next year. We already meet a lot, and it's tough to get, find times that everybody can meet. But based on the feedback we get, where we get the most interest, we'll start with that one first and kind of roll them out.
We got a class available for the OWA on 12/25.
Right.
What bar is that?
Okay. Good. Did you have something?
Nope.
Okay. Mr. Chairman, that
Yeah,
concludes
okay,
our public session, sir.
So we need a motion to move out of the public session.
So moved.
And we need a, okay. Is there a second? Any objections? Hearing none, the motion passes. So we need a motion to move into executive session